Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video I am looking at two different companies that some of you have asked me to look at recently, and that is S&P Global and MSCI. Those two companies are credit rating companies. They are in the financials. Okay, let's make it clear, they don't deal with any credit detail, any banks and riba and all of that stuff. They credit rating companies, they indices and all of that things will be, and then we will look at basically the business model in a second. But before I do that, I just want to apologize for my voice is all over the place today. Alhamdulillah, I'm getting better, because my voice is literally last couple of days I sounded like a alien, but right now it's actually coming back. This is my portfolio, is on Trading 212. The company I use is called Trading 212, basically the brokerage, based in the UK and other European countries. They are taking new customers, so if you're interested, use the link in the description. Okay, they are giving you free share. I'll get a free share if you obviously buy as well. And just to be transparent, sometimes I get it, sometimes I don't, depending on the month or whatever it is they do. But yeah, it's actually a good platform. I use it. I find it easier to use. Some of you recently said, you know what, there are what other companies out there. Companies like, for example, Interactive Brokers, which is another account that I actually use on family wise. My family have basically an ISA account through there as well. So alhamdulillah, there's are quite a few companies out there that are quite good, but I do like Trading 212 for simplicity and how actually the interface looks and so on. Now, this is not portfolio value at the moment. Okay, I've just made a sale of 1,500 something, 1,300 something, and I added £500 just today. I will be buying some stocks today, inshallah. So that money will be going to some of the stocks that I've actually got on my watch list today. And as you can see, we still have 5,400, almost, let's call it £5,500 to deposit between now and the 7th of April. We're still in January, so we got whole February and March to come. So next 2 months I will be adding about £5,500 to maximize my ISA account. But yeah, if you're interested, look at Trading 212. I do actually like the platform and so on. Let's now have a look at these two companies. But actually, before I do that, let me just quickly mention the earnings report. I will be doing a video over the weekend, inshallah, just to kind of summarize some of the points, some of the things that I've seen in terms of some of the companies that reported, if you like. So J&J reported, that was in my portfolio. 3M, Union Pacific, Microsoft basically reported last night. Texas Instrument, Canadian Pacific. There's quite a few companies that reported, and just today ASML actually reported, and the earnings was not bad at all, but the stock is down. But guess what, ADP actually is down quite a bit. Let me just very quickly show you. It's down almost to 5%. It was 5.5% just this morning. I will definitely be adding to this company. I just bought it recently. I was hoping a pullback, and that is exactly what's happened. So now I'm going to make most of that opportunity and buy some of that company basically today or tomorrow. We will see. As you can see, Microsoft was down about 3% not long ago, but right now it's just about 2.5%. The market is still open, so I'm sure by the time it closes today, it will probably be 3 or 4% down. The earnings was not bad. I just checked the headlines, but I think his guidance was the only thing that didn't look great. So it will be interesting to actually dig deeper and just see what happened to Microsoft in terms of overall earnings. But let's have a look at the two companies. First one I want to talk about is actually S&P Global. This company, like I said, is financial services. They don't actually invest in the riba side of things, banks or anything like that at all. Okay, I know some of you have question marks about this, but this is a great rating company. In fact, is the S&P ratings is the largest credit rating agency in the world. So a lot of companies, firms actually use this company. The banks use this company to rate their own basically investments and so on. So they don't actually look at anything to do with anything to do with the river side of things. The firm's other segments include market intelligence, which basically provides the desktop tools and other data solutions to investment banks, corporations, and other entities, as well as indexes as well, provides benchmark for financial markets and monetized through a subscription, asset-based fees, and so on, which is basically one of the reasons I'm attracted to this company, because they are almost basically, as long as the financial world exists, this company will exist and will end up doing really good. Right now, $363 per share. EPS about almost 12, $120 billion market cap. It has a wide economic moat and just below and above 1 beta. So beta is not that bad at all. When you look at PE, it looks a little bit high. Forward PE is also looks basically expensive when we look at in comparison to financials. But financials normally tend to have a lower PE, and we're looking at all the banks basically, because if you look at the financial sector, it's just full of banks, right? So the banks normally tend to have a lower beta. For that reason, I don't think we can compare them like for like. But when you compare it to the 5-year average PE, which basically tells us whether this company is undervalued and overvalued, when you compare it the last 5 years or the 5-year average, is actually lower right now, and it's basically higher than the level of average 5 years. So that tells me maybe a little bit pricey right now. It would be maybe great if it comes down maybe at least 5 to 10% in the next, I don't know, maybe year or so. Then it will probably be a good investment. But right now it seems basically expensive based on just the valuations on the just PE itself. Price to free cash flow is actually great. Okay, dividend yield is basically quite low. Latest increase was 10%, 5-year growth rate of 16%. Annual payout is $3.40, 48 years of increasing. So they will be soon a dividend king, which is a company that has increased its dividend for 50 plus years. Payout ratio is 28%, dividend safety of 99%. Free cash flow $2.3 billion, which is absolutely brilliant. And now I've added one more thing here, free cash flow yield, okay, 3%, 3.3%, which is really good in comparison. Normally, ideally, okay, to invest in a company, basically 5%, 4% up and above is actually quite good. Okay, but not many companies actually meet this criteria. I'll be honest, even Microsoft and so on will not meet that kind of thing. The reason we want to basically higher free cash flow and higher free cash flow yield is to make sure the company actually can pay that dividend. If they do pay dividends, okay, they can buy back their own shares, they can write off some debt, they can buy other companies. So there's a lot of room for improvement. So they can basically increase their revenue by actually reinvesting that money into the business. And you don't want to own companies that have a very low free cash flow yield or free cash flow generally. Okay, and one of the reasons I actually sold the stock that I sold today was because of the free cash flow and the free cash flow yield. Okay, and I'll let you know what that company is when we do a portfolio update. Profit margin 33%, operating margin almost 50%, return on equity 12%, total return in the last 10 years we are looking at 22%, which is very, very high. So current ratio, we're looking at just anything above 1 is basically perfect. So that means they can cover slightly below 1%, but that should be a 1, but that should be okay. That shouldn't be a problem. I'm sure they have plenty of cash to cover it if they need to. If you haven't clicked to subscribe to the channel yet, please do it. It helps the channel. If you haven't liked the video, please do it as well, because it really helps the channel overall. Now, next year, we're basically looking at about 12%, 12% growth in terms of earnings. The next 5 years, about 8%. Current price is 363, like we've seen already. Fair value 193, according to Simply Wall Street. They are saying this company is overvalued 90%, which is ridiculous. I don't think that is the case, but sometimes they do it. Simply Wall Street's just got some crazy valuations sometimes, but I do believe Morningstar is actually better. I've been using it for a couple of years and I actually do like their valuations and basically the model they use. So 370 is a kind of fair value right now, and TipRank is actually saying $397 per share, about 8%. Okay, and then 410 according to Seeking Alpha, about 11% upside, and it's a strong buy from Seeking Alpha. In terms of Sharia compliance side of things, is absolutely brilliant, just about below 12% interest bearing debt and 1.4% in terms of interest bearing securities. So that's the first company, and again, like I said, this is one of those companies that has wide economic moat, is actually growing really fast. The PE seems a bit expensive right now, but I'll be honest with you, if the average 5-year average is about this much, okay, that's not much of a difference. So for that reason, I do own this company in my portfolio. Just to be transparent quickly, I will show you. There we go. I do own it, 5 shares. I've recently added to, and I will be adding to it as we go along in the next few weeks and months to come, inshallah. MSCI is another company, is in the same sector, financial services. Okay, it provides benchmarks to asset managers and asset and owners. Basically, the company is holding over $1 trillion in ETFs and assets linked to the MSCI indices. Okay, so they don't hold that, but they have that much money that's linked to some of their basically indices that they own. They basically do the indices analysis segment, provide portfolio management, risk management, analytics software to asset managers and asset owners and so on. So again, they're very similar kind of companies, work in the kind of similar sort of industries. Okay, currently trading $502 per share, EPS about 10. Market cap is actually smaller than the other one, so we're looking about, let's call it $41 billion. As World Economic More 1.11 beta, so it's slightly higher than what we normally like. Check this out, the PE is quite high, forward PE is high, and 5-year average is about 46.55. So it is actually where it should be normally, right? Price to free cash flow, again, 42. Now, when you look at this is a company that, based on the 5 years, this is a company that has been trading higher multiples for a long time, maybe because of the growth side of it, maybe because it's a very solid business and so on. We will check that in a second when it comes to the predictions for the next couple of years. Annual yield of dividend yield of 0.98, let's call it 1%. Latest increase was 20%, 5-year growth rate about 29%. And the annual payout is $5. They have increased this dividend for 7 years in a row. Only 39% in terms of payout ratio. Dividend safety of 61%. This is the only reason that I wouldn't actually invest in this company right now. Free cash flow seems a little bit low. I don't understand why that's the case. Okay, I would expect at least a $2 billion plus, but hey, there we go. It's just less than $1 billion. Free cash flow yield, we're looking at about 1.70. So they both, in fact, I'm going to change this to 5, because going forward it will be nice if we can find companies that whose free cash flow is above 5%. If we can do that, that would be absolutely amazing. But I would take 3 to 5 basically or more. I'll be honest with you, right? A lot of the companies I do own has a free cash flow yield of 3 and above %, okay, which is quite decent. Profit margin is really good. Operating margins are really good. Return on equity is basically negative right now. Maybe there's a negative equity situation going on there. 32% total return in the last 10 years, which is absolutely amazing. This is probably one of the reasons why it's trading higher multiples, because of what they have returned in the past. Maybe people expect the same thing. We'll look at that in a second. Current ratio is actually above 1, which is absolutely fine. And then next 5 years, basically next year we're expecting 11% growth. Then next 5 years, 13% growth every single year. Probably this is one of the reasons. Okay, and now it's not technology high. It's not like in the 20s, in the 30s. But for a stable company that has been around for a long time, paying a stable dividend, has a decent cash flow, right? This is not bad at all. So 11% to 13% every single year, that is not bad at all. Right now, according to Simply Wall Street, it's actually saying it's overvalued about 23%. According to Morningstar, it's saying 38% overvalued. But according to TipRank, it's actually saying it is 3% undervalued or 3% upside if you buy the share right now. And when it comes to Seeking Alpha, they're saying about 2%. So these two are very, very similar. But according to Seeking Alpha, it is a buy. And from business perspective, in terms of Sharia compliance side of things, we're looking about just fine. I mean, there's no huge problem here when you look at this. Right, so those are the two companies. I'm going to very quickly show you in terms of revenue growth for the first one, okay, where we are, because that's really important as investors. Right now, where we are is $8.3 billion in 2021. When they report in the next few weeks, they basically expected to report $11.79 billion. Okay, then the year after, $12.5 billion in total revenue there is. If we look at annualized EPS and take out the estimates, you can see it's also heading the right direction. And if we do basically add the estimates, there is basically expected a little bit of a decline next year. So the actual was 13.69, and then there's about 11.12. Okay, so there's an expected little bit decline. If that was the case, it would be interesting to see what happens when they report, because if that happens, then I'm sure the stock will be going down quite a bit. So we'll see. We will see when the actual company reports. Right. Right, so the next one is MSCI. If we look at their total revenue in the last few years, you can see it's beautifully growing, and then next year, this year basically 12 billion. So when they report soon, that will be $2.24 billion, and then $2.45 billion the year after. EPS is also growing. If you include the estimates, okay, it also looks like it is heading the right directions. Okay, unlike SPGI or S&P Global, it's actually heading the top, basically going upwards, if you like. There you have it. There's two different companies. Some of you asked me to look at those two companies. What I will be doing, inshallah, is I will be letting you know what stock that I've sold and what I've done with this money. So we are now on the 24th, I believe 25th today of January. So in the next couple of days, inshallah, I will be doing a portfolio update. I will tell you what I'm doing. I will be adding more money every single week in the next few weeks, just to make sure that I maximize my ISA account. If you're enjoying this type of videos, if you are enjoying the content here, if you are, like what we're doing here, and the transparency and everything else, please just give the videos a like. They do actually help. Have a wonderful day. Assalamu Alaikum. And then inshallah, next couple of days, I will be also doing another comparison between two great companies. So inshallah, stay tuned for that. Have a wonderful day. Assalamu Alaikum.